Welcome to the Millennial Money Canada podcast. You have myself, Guillaume, Girard, and Sam Lichtman, financial planners, wealth managers at Millen Wealth. And then we're joined by Mohammed, who is a partner at Copilot Tax. Guys, welcome back on the podcast.
Yeah, thanks.
Thanks,
It's
man.
it's an exciting time. Like we're gonna spend, I think, the first 10 minutes here talking about like what's happening in the world lately, and even just in our own lives a little bit. But we've got an exciting thing to talk about too, because Guillaume, you just did an insane athletic accomplishment. You ran 50 kilometers, I think, worth of mountain trails a week or so ago. So I'd love to hear about how your ultra marathon went.
Yeah, it was good. That was the second one this year. It was 50K, 3,200 meters of elevation. So that's just put it in perspective. Like that was a lot for me. The last one was only 1,900. So it was quite a bit more, and it was great, man. It was the weather was pretty nasty. Like up on top of Whistler was freezing, even at this time of the year, like 3 degrees, and like with the wind and stuff. But yeah, it was great. It was 8 hours, about like 4.5 of running, and then about 3 of hiking, and then like 20-ish minutes, almost 30 minutes of kind of idle and rest and stuff. So yeah, it's great. It's a good experience, and that's it for the year, for at least for ultras.
Yeah.
But that was fun, man. That was probably my best, by far my most enjoyable race, like compared to the one in July. I think paced it better, and my training was like everything was on point, and it was just like super enjoyable. Average heart rate was like 130. Just give you a perspective, like that's on the lower end when you're running and stuff. But it was cold, so of course colder weather like really brings your heart rate down. But it was not like a 170, 180 heart rate, like dying, that type of effort. So yeah, it was cool. It was really fun, man. Ultras are fun.
How long does
Yeah,
it take to train for this?
the peak this time was it was about 12 we count hours, so it's about 12 hours a week of like it's called on feet essentially. And then at the peak I was almost like 85 to 90K a week with like 4,400 meters of vert per week. So I did 2 weeks back to back at my peak, and then like 3 weeks ago, and then after that you start tapering towards the race, and then the last 2 weeks you basically just like keeping things idle because there's not much improvement you can gain from your training, and then you just show up on race day and full of carbs and full of sodium, and yeah, it was good. It's all about this game. It's a lot about nutrition and hydration. It's as much as important as anything else. If you can dial this in, it's gonna make a night and day difference in your performance, which is cool.
I think the only thing I knew about ultra marathons before meeting you was from David Goggins' book. And I'm curious, the way, I don't know if you've ever read David Goggins or like how he describes his ultra marathon training. Like, is it as ridiculously hard and intense and like as he makes it out to be? Now, I'm not trying to take anything away from that, but like he's talking about like breaking his ankles while he's running and that type of stuff. Does that all come down to like preparation so that you don't like kind of get into that situation, or like how is it like when you're actually in the moment?
Yeah. He's a little bit extreme. So what I mean by this is, there's 2 caveats here. One is I've read his book, which I can't remember the title right now, but it's like it's pretty awesome. But yeah, about the
Can't Hurt Me.
pain.
I think Can't Hurt Me is the book.
Can't hurt me, exactly. Yeah,
Yeah.
about the pain, it's not nowhere near as like kind of how he describes it. But the other thing that he does though is he does much longer distances. As much as you think 50K is big, I mean he does like 200 miles like ultras, right? That's 240 miles ultra. Those are almost 400K. Like you're talking 3.5 days maybe on feet. 2 to 3 days on feet, which is like insane, right? So he's in another like level, and there's a lot of like runners in that realm. I have no interest of going there. I want to wake up in the morning, I get my race, I'm done early afternoon. I had a bath, went for dinner with my fiance and her dad, and I'm sleeping in my own bed at night, and that's perfect for me. That's good. I just want to get faster. Actually, that's my goal, to be honest with you. But
That's
yeah,
awesome.
so yeah, it's fun.
Congrats. That's a huge
Thanks,
feat.
man.
Like that's amazing.
Thanks.
I have no ambition to try to do that, but like now I'm competitive and want to, I don't know. So
Dude,
that's incredible.
I'll get you. Sorry, I'll keep you updated because I have a 5K on Saturday. So I'm going
Yeah.
from 50 to. So
Are you going for like what's your goal for time?
I don't. I have. That's the thing. I have no clue where I'm gonna land, and I don't expect to be that fast because I just haven't trained that gear in a while. So I just want to see the conditioning is there, but the speed is a skill. So, anyways,
Yeah.
stay tuned. I mean,
Yeah.
I do have some goals, but I don't want to put it out there because if I.
Sub 20 for sure.
Yeah, well, I'm excited. I have
Yeah.
no clue because I just haven't been doing it for months, right? So,
Yeah.
anyways,
Awesome. We've
yeah,
got yeah,
yeah, yeah.
there's been an article that's been circulating, Mo, and I know that you've picked up on this. And I think it's given people maybe a misconception of the Canadian tax system that we might have a death tax or an estate tax, and why, an inheriting brother and sister, I think it was, ended up having to sell a family cottage in order to pay capital gains tax. And the way it was presented in the media, I think came off as a bit disingenuous. But it's been a big story that's been circulating recently. I'd love for you to kind of share some thoughts and insights on that, and maybe address some of those misconceptions that the article may have. I didn't read the full article, but I know the headline was quite alarming. So yeah, do you want to just kind of jump in and share a little bit about that and what you've seen?
Yeah, I think definitely the headline really, I think, caught a lot of eyes, and there's a big surprise to people because they're like, can't believe Canada has an inheritance tax and there's so much tax and all that stuff. And it could be a lot of tax, frankly speaking, but I guess there's just a lot of, lack of education, and also our tax system is kind of complex of what happens when you pass away and what are the taxes. And really, any kind of tax that's deferred throughout your life. So, if you have a rental property that you've never sold, you have investments that went up, you have a RSP, all of that will kind of get taxed at death of the surviving spouse. So, on death of the first spouse, all these things kind of roll over to the surviving spouse, and no tax has to be paid. But when the surviving spouse then passes away, then all those taxes that were deferred during their life will then have to be paid. And so in this case, they basically had a property and an RSP, and the RSP was fully taxed on the death of the surviving spouse. Both parents died in the same year, so when the second spouse passed away, the full RSP balance was taxed, and then the cottage or the property that they owned was also taxed. Typically, when you have a property and you live in it, it's tax free when you sell it or pass away, and that's because of the principal residence exemption. I think one of the things the article didn't necessarily do a good job of diving into is that they actually owned another property at the same time, and that's why they had to pay tax on the cottage. And then they basically had to kind of use all the full amount of the RSP, which was about 700,000, to pay for the tax of the RSP and the deferred tax on the cottage. And a lot of the numbers, weren't included. The cottage did go up in value by at least, I think I saw a thread, it was about 1.5 million. And, the numbers aren't very clear besides the RSP, besides the sale, the first home isn't really discussed. And I think that caused a lot of outrage. Uh, and I think, it's just kind of understanding how the tax system works. When the surviving spouse does pass away, you do have all that tax that got deferred during your lifetime will come into play, and you will have to pay that tax now before your beneficiaries or your children can inherit, your money.
And just to confirm, was there any plan? And again, I didn't read the full article, but was there any planning done, or was it any planning discussed in the articles, or they
So
kind of got caught by surprise?
they do talk about a couple things, but I'm not necessarily sure that they were the best ideas, right? What the biggest thing that they spoke about was an RSP drawdown strategy. But this couple died at 62 and 63, and it's pretty rare that, you see two partners die at that young of an age. And you don't want to just, draw down your RSP early in the anticipation that both of you pass away, because then you could be losing out on a lot more tax deferred compounding, right? And this is something probably you guys model, right? Whether a drawdown strategy makes sense or whether, it makes sense to stay invested. And they mentioned, oh, you could, put it into your TFSA. We have no idea how much, like if they even had a TFSA, how much room was in the TFSA or anything like that. Like the article didn't do a good job of explaining all their assets. It just kind of highlighted the ones that were generating tax. So I think, that it might have been a kind of like short-sighted, or I don't know what the word is, not a holistic way of thinking about their planning.
Yeah, like I think people, they do have some, obviously we talked about this last time a little bit, some level of onus on themselves to understand, the tax implications of the decisions that they're making. But given as well that the couple died fairly young, in all contexts, like, there are things you plan for the worst in some senses, right, and hope for the best, right? Like you plan to kind of cover off what happens if I, were to pass away, who gets my money, what taxes are owed. That snapshot, honestly, should be done on an annual basis, right? If something were to happen to me this year, how would I cover off the tax liabilities for my family? How would my family cover it off? Who's the money going to? Those types of things. That comes through a financial planning update. It can come through a will update when there's a significant life event change. People should be pointing out those risks, saying that like, hey, if you want to pass on liquidity to your family, that would have been a very easy thing to identify ahead of time had they sat down and done that. And maybe life insurance could come into effect there. Maybe making sure that, they had the right beneficiary designations on their registered plans and things like that. While that doesn't negate tax, that can distribute things a little bit more evenly. So I think there's things that, you have an onus on yourself to be aware of in your own financial plan. And then also, I think people started really hating on RRSPs because of this as well. Like, I can't believe that, like, RRSPs use so much tax on this when you die, so I'm never going to invest in one. It's like, we've done the math. If you have an RRSP versus a non-reg, even if it gets taxed 100% in the year of death, you are still better off with the RRSP, right? And there's so much to take away from that. But I think just even a snapshot of this would have helped that couple who unfortunately passed away, and the kids have a better understanding of like, this is what's actually about to happen.
Yeah. And I'm not sure about the actual numbers, where like what was the starting wealth, what was the ending net wealth, like in that specific scenario. But one thing that it's important to to remind yourself is that, of course, if you have, let's say, a cottage that you want to keep in the family, and then there's like no then there's not enough money outside to pay the tax liability, and then let's say you have to sell the cottage, that can be a huge like emotional challenge in a way, right? That it's very unfortunate, essentially, especially if you want to keep it. But let's say you're in a situation where you're never going to pay more tax than you have assets for, right? I mean, just taxes are part of life. What I mean by this is, it's a natural thing. It's like death and taxes, right? Those are natural things that happen. So, again, it's always up, try to minimize it, but ultimately it's just to be mindful that like it's inevitable in some fashion, right? So, yeah, just like, I'm not sure what was the net estate and whatnot, but like the article, of course, wanted to like really, again, target like the amount paid and whatnot. But like, I mean, if let's say they're all left with like over $1 million each, I mean, it's not like the government took everything and RSPs are so bad and like you should never buy a cottage. Like, those are not like the takeaways, right? But sometimes it kind of is portrayed that way because fear sells, right?
And it's not like there was a liquidity problem. It's not like they didn't have cash. Like, presumably they would have had the proceeds of the first home, all other, if they had TFSAs, they had enough cash from their RSP to pay all the taxes and keep the cottage. So I don't even think it was a cash flow problem. I think to me, it's just really two issues. Number one is the need for financial planning, so people can understand, what could happen. And then number two, estate planning, but not necessarily in what could we have done to save tax, but more about like, hey, educate the next generation on what happens, right? This is what your net worth is, but your net estate is going to be a lot less because when you pass away, there's all these taxes. And so just giving them a little bit of education rather than just doing your will, blindsiding your family like that. I think that's the lesson I take away.
This is like a perfect transition into the topic of today's episode. Would they have been better off by putting that cottage in a family trust? So we are going to transition into talking about family trusts, going through the basics of family trusts, and everything like that. So Guillaume, I know you've got an outline for this. I'll turn it over to you.
Yeah, no, exactly. So the goal of today, I mean, the title is Downsides of Trust. Like we want to talk about, what is a trust at the basic level, and then we want to really share with you like opportunities where we can identify opportunities where they are suited, but also where they're not suited, and then of course cover like the drawbacks that comes with trust. And I want to put a caveat here where we're not lawyers here. Our job, and we're going to talk about this about what's our job here, and as financial planners, we're usually one of the first ones if the accountants haven't really spotted yet, or let's say they didn't have a lawyer as a relationship with a lawyer. We are usually the first one that will identify would there be an eventual possibility of implementing a family trust structure with a holding company or whatnot, right? Based on the client's goals, the objectives, depending on their situations. And then I want to hear from Mohammed as well, like what's his involvement, right, from an accounting partner in identifying those opportunities and what he sees from his side, which is going to be interesting. So let's kick it off, Mo, with what is a trust at the basic level?
So I think a trust, there's many different types of trust, but basically the idea of a trust is that someone holds something for someone else. So someone is holding, some assets, some money, some investments for the benefit of someone else, right? And so just a common example, let's say there's someone who you don't necessarily trust with a lot of money. You don't want to necessarily gift them all that money so that they could spend however they want. What you could do is put it in a trust and hold it for their benefit. So they're not really controlling it, but they can reap the benefits of those investments of that money. And that's kind of the most simplest way to explain it. Is that how you guys kind of see it as well? I just want to understand if that definition makes sense, and is that your kind of understanding of what trusts are, or is there a better way that you think there is to explain it? Because sometimes when I talk to clients about this, it's a hard thing for them to understand.
So,
Yeah, the way I've viewed trust is, and how I've explained it to clients in the past, is that it's essentially like a way for them to hold assets separately. They get taxed separately, and apart from everything else. And there's a lot of different rules surrounding them, and they can be beneficial from a tax perspective. I try to stay out of the weeds kind of in the technical terms, because I know there's many different types of trusts, and different types of trusts can behave differently. But it's just a separate entity, if you will, that has different tax requirements, and in many cases can be tax beneficial depending on the situation. So I would say your definition is definitely more technically accurate, and probably should take that away and use that to explain to clients. But that's just the way I've described it to them in the past.
Yeah, sometimes I use similarities to a partnership. So let's say two people want to come together to make some money to invest. They're kind of sharing in the control of the partnership, and they're sharing in the benefits. It's like a partnership, but sometimes the people who are controlling the partnership are not the same people that are benefiting from it, right? So that's another way I kind of explain it, because the income does flow through, similar to how a partnership is. Each partner is taxed on their share of the income. In a trust, each beneficiary tends to be taxed on their share of the income. And that share sometimes is discretionary. So you can kind of allocate how much you want someone to be taxed, or how much income you're going to give to someone. So basically the main benefit of trusts, it's, people often say it's for tax, but really the main benefit is actually for flexibility and control. There are many types of trust, but the main common one, business owners or, high net worth individuals will use are, kind of inter vivos, basically family trusts, right? Trusts set up for families and everything. And there's generally no tax benefit. I don't want to say there's no tax benefit. Another way to phrase this would be, there's no tax benefits that a trust can give you that you can't achieve without a trust. So any tax benefits with a trust, you can generally also have without a trust. Now, why do people use a trust then for tax? It's because if you were to give someone money to invest, then you are losing control of that money. You don't know what they'll do. With a trust, you can kind of maintain control, you can maintain flexibility, and that pairs very well with a lot of tax planning.
Can you go through some of the definitions involved with a trust? So for example, if I want to set up a trust, who am I in relation to that trust? I know there's the trustee, there's the settlor, there's the beneficiaries. Can you go through just quickly, like, who's who in a trust?
Perfect. So there's generally three groups of people in a trust. There's the settlor, and the settlor is kind of the person who sets up the trust. That's the easiest way to think about it. There's the trustee, and that's the person who kind of controls the trust, controls what happens with the money, and sometimes it's a group of people. And then there are beneficiaries. These are the people who benefit from the trust, right? And so there are very punitive tax rules when you have people who are in multiple categories, right? So if the settlor is the same as the trustee or the beneficiary, then there's punitive tax rules. So you typically don't want to find yourself in too many of these categories. And a lot of times you don't want to give up control. So usually the person who's thinking about setting up the trust is the trustee. And then the people who are benefiting from the trust are the beneficiaries. And then sometimes the settlor is someone random, kind of, who's not really involved with the trust.
Can we talk about one of the examples, at least that I'm, involved in at the moment with one of my client, and also this is like I would say a typical client cases that we come across when we're serving business owners. I just want to kind of break it down with the listeners. Of course, I'll change a few of the numbers, but just want to like pick your brain in here as like, what is the process, who's involved, what are the main outcomes, and then as well as covering like when is it applicable and what are the downside of applying that kind of structure. Okay, so a typical client, at least that I've identified, is someone who's a business owner who is expecting to see significant growth in the value of their business. They are involved in their business, but their spouse is not, and they have kids as well. And they have the intention of selling their business. In this specific case, it's anywhere between 5 to 7 years. And this is important because you need to start implementing those structures early for various reasons, right? But this is kind of like the typical client case, I would say, that I've come across as a financial planning professional. I'm sure there's many others, but what's your take on kind of this specific example? And just share it from an accounting point of view.
Perfect. And I love this example, and this is probably one of the best benefits of a trust, the ability to kind of spread, take advantage of the tax attributes of different family members to, benefit from the eventual sale of your business. And the idea behind this is that everyone can really sell a business for a gain of up to 1.25 million tax-free, right? So if you, Guillaume, if you want to sell a business and, it's appreciated by 1.25 million, you can sell that tax-free. Now, I don't remember if you said girlfriend or fiance, but I'm gonna say it's fiance. Were you engaged? I think, right?
Oh, well, it's a spot. This, you mean me? Yeah, I'm engaged. Yeah. I'm getting married next summer. Yeah.
Okay, got it. So let's say you and your fiance. Let's say your fiance also has this 1.25 million, right? That means she can also be a shareholder, and if you're to sell your company for a gain of 2.5 million, she could benefit from her 1.25, and you can also benefit from your 1.25. And so what happens if you have children? Then they could also benefit from their 1.25. There's no rule that says, children can't benefit from this as well. They actually very much can. So you can actually give them all shares, and they could, when the business eventually sells, you can, use their lifetime capital gains exemption to sell the business tax free. Now, you may not want to actually give them ownership of a company where the value can go up to 1.25 million. Like if, let's say you had a minor child or adult child, and they're holding $1 million worth of your company's shares, they can act very recklessly here. And that's where kind of a trust comes in. So you don't need a trust to benefit from this, but it's really beneficial because you can maintain control and you can maintain flexibility over the shares. And then when you need to benefit from it, you could benefit from it by, distributing or allocating some of the gain to them so that they can use their lifetime capital gains exemption. And that's how kind of a family trust would be a benefit for a business owner who sees that their business will really grow in value and kind of plans to sell it.
And the way I understand it is that the family trust would be owning, and then again, without going too much in the specificities of like which classes of shares, but the family trust would be owning shares of the company. And that's why when you sell the company, the capital gains is going to be allocated to the trust, but then the trust is going to be able to flow through that capital gains to the beneficiaries. And that's how you can multiply that capital gains depending on who is the beneficiaries of that trust. That's how I understand it. And I've only worked on it in conquest planning, which is really cool. We can model all of this. So I find it like pretty fascinating. You can model the transactions, you can allocate again that like tax impact for each beneficiaries. And that's why you would be able to create like a non-taxable event up to like $1.25 million, right? Depending on how many beneficiaries you have.
No, I actually didn't know you could model it. That's pretty amazing, to be honest.
Yeah. So that's cool, but that's how I understand it. Okay, so
I actually love that explanation. The one thing I want to highlight, or Sam, actually, were you going to say something?
No, go ahead. I'll jump in after.
The one thing I want to highlight is a lot of times people don't originally set up their company with a trust, although you could, but you don't know how viable that business is going to be or anything like that. You can't just transfer. Let's say the business is currently at 500,000, right? Or currently at 1 million. You can't just transfer that 1 million to the corporation. You have to freeze your ownership, and the future growth has to go to the trust, right? And so when I bring this up because the article, a lot of people were like, they should have transferred their cottage to a trust. And among the many different issues with that, there's a deemed sale when you transfer it to the trust, and you would have to pay tax when you do something like that, right? So that is what I just want to highlight. It's the future growth that the trust is going to get.
Actually, that's a great point, because that's also important of when you want to set up. So you want to set up as early as possible if you are confident in the expected growth of your company. I mean, there's a big caveat there. But let's assume you're on that growth trajectory. The earlier you set up that structure, the better, so that you can allocate the growth to the trust. That's what you got you.
But just on that note, so from my understanding, like it's different when you're talking about capital property, like a cottage and then shares of a company, right? Because, okay, correct me if I'm wrong on this, but my understanding is when you do the freeze, you exchange your common shares for preferred shares in most cases, right? And the commons are now owned by the trust and you own the preferred shares. That's a deferred rollover, if I'm not mistaken. So meaning your adjusted cost base would stay at what your commons were, but that would just be owned by preferred shares. So you would still realize the full taxable nature of that gain at death, right? But in the case of a property, is there that same deferral ability where you can basically say, I'm rolling it into the trust, but I'm rolling it over at the adjusted cost base so that I don't actually pay that tax?
There are for certain types of trusts, but the ones that people are kind of referencing, there aren't, right? So which is a kind of like, it's called the inter vivos trust, but I just call it a family trust. You don't have that ability to kind of defer it when it's kind of a proper, like a rental, a cottage, real estate property.
So essentially, like there would have been no real benefit for them to put it in a trust in that situation from a tax perspective alone. Right. There could have been control perspective, like you mentioned, like you maintain control of the property. And, it's not just when one of the kids wants to sell it, they can just sell it. Right. Like there could be some level of control that the trustee has over that property when they transfer it in. But just from a pure tax perspective, there would have been the deemed disposition when you transfer it into the trust. But then, correct me if I'm wrong here, does the property then not kind of flow over the death of the original settlers, right? So like if they pass away, that doesn't necessarily impact the property inside the trust. What would impact the property inside the trust is that like if there's 21 years that passes from the establishment of the trust, then there's a deemed disposition of all the assets inside the trust, and that's when the tax bill occurs. So it wouldn't have actually mattered the death of the parents from a tax perspective. It would only have mattered if that trust was set up and was close to that 21-year mark. Is that an accurate understanding of it?
That is an accurate understanding, but there's also kind of trusts are, and this is why like we'll eventually I guess talk about the downsides of trusts, but they're so complicated, and there's all these like rules that like very few people know about trusts. And one of them is when you have personal use property in a trust, there's this one rule that applies, but CRA says we won't apply it, but then there's this other rule that applies and CRA says we will apply it. So it gets really complicated, and to be honest, that added complexity is not worth, in my opinion, except in very limited cases, it is not worth the trouble, right? You are right in exactly the 21-year rule and all that stuff, and you can roll it out right before the 21-year rule, so the kids kind of just inherit it and get that deferred gain in their names. But then there's all these other rules with trusts that could apply in that case, and so you really need to be careful with them, and they are a huge headache in complexity and administrative work to deal with.
Yeah.
Yeah, go
Sorry,
ahead.
one thing here. I want to go back to Guillaume, your example on, the kids benefiting, the minor kid benefiting from their $1.25 million capital gains exemption. And in many cases, it's not even minors. It's like, dad's 70, wants to sell the business, and the kids are in their 30s or 40s, right? And when does it make sense to not multiply the capital gains exemption? I'm going to give you an example, and like, let me know if this is makes sense. So like, if the kids have their own business that they intend to sell at some point in time, and they're going to use up their $1.25 million capital gains exemption today by the sale of the dad's business through a trust, right? Does it actually make sense to set it up that way in cases like that, where it could be looked at as, one in the hand's better than two in the bush, right? Like, okay, we know that we're going to, get like inflation adjusted amounts on the 1.25 million, in 20 years. If we want to sell our business, it might be 2 million or 2.5 million of tax-free capital gains. But like, I could take 1.25 million of it today, and who knows where my business is going to be in 20 years. There's that aspect of it, but then there is that other aspect where it's like, well, I've got my own business that I want to sell at a certain point in time, and I want to preserve my capital gains exemption. Is there any consideration of like, hey, maybe, what, if you got your own business, you might not actually want to do this?
Yeah, I think there's competing interests here. So number one, it's, I would assume tax savings today are better than potential tax savings, but also, it's that individual's kind of right to want how they want to use it, right? So I think that's a discussion kind of on what the family ultimately wants, or what that child ultimately wants. The second thing here is that now, when you have family members who also are business owners, who also have corporations, you get into a lot of other kind of tricky rules. And one of the tricky rules is that a beneficiary, so someone who can benefit from a trust, is also deemed to own the trust because of these weird look-through rules and everything. And so what that means is that his corporation and the corporation, where that the trust owns, are now associated. What does that mean for them to be associated? That the $500,000, the low tax rate you pay on the first $500,000 of income has to be shared by those two corporations. And if one of those corporations is earning passive income above 50,000, then it reduces that shared 500,000 that they have to split between them.
So if the common shares of the operating company are owned by the trust, and the beneficiary has a business, they're now deemed to be associated businesses, and they've got to share the small business deduction.
Yeah, exactly.
That's fascinating. I had no idea that was the case. Wow.
Yeah. Go ahead.
No, there's a lot of tricky rules here. Another one let's say two partners have a business. Say the husband has a business and the wife has a business, and the husband's going to set up a family trust, and they want to make a child one of the beneficiaries, which is common, right? There's another rule, and that's why I said trusts get really tricky. There's another rule that says the mom, and let's say the child is under 18. There's another rule that says the mom is deemed to own what the minor child owns. And since the minor child is a beneficiary and is deemed to own what the trust owns, the mom's corporation, even though she's not a beneficiary of the trust, and the corporation that the trust owns are now also associated. So even though the mom isn't a beneficiary, just because her child is a beneficiary, her corporation is now associated with the trust corporation, and they also have to share the small business deduction. So there's so many of these tricky rules with trust that you really need to be careful with.
Wow. And that's where you guys come in and make sure clients know that. So like, this is a good example of like how we can identify potential opportunities where we see a trust could fit. But then there's subject matter experts that need to come in and make sure, like the lawyers that need to come in and make sure that, like, hey, here's the implications if you set this up. And here's the potential downside. So we're talking about potential downside of trust. Well, look, if mom and dad have two separate companies, those aren't considered associated companies already, from my understanding then, as long as they're not dealing with each other in any meaningful business way, that they would become associated companies, meaning they would have to share the small business deduction, meaning essentially like a higher tax rate on their active business income. And if they were to name a child as a beneficiary, that's important information. And I think it goes to the distinctions between like where we as financial planners can identify a potential opportunity, and then you go, hey, Mo, does this make sense? And you're like, well, actually, this might be a downside of doing this, and think through things with like a very clear lens.
No, I think you literally hit the nail on that point exactly. The issue identification and execution. I like having it as two distinct kind of roles because it lets you kind of benefit from each other's kind of skill set. So I definitely agree with that. Were you going to say something, Guillaume?
I might have an interesting question. That might be a curveball here. But if someone doesn't want to use a trust, like they can just be like shareholders of the corporations, and you can use them directly to multiply the capital gains. But then what does that mean is they end up with their portion of the value of the business once the business is sold, assuming you sold a share of the business. Are there any other ways that you could somewhat guide that the proceeds that were distributed to the beneficiaries, assuming they're, early 20s and whatnot? Like, are there any like other ways you can put guardrails into, or like they're just non-existent? It's either you go kind of the trust route, or when the proceeds are distributed, it's in their checking account at the bank type of thing, and it's like over, let's say, $1 million, and they're like early 20s. That can be challenging, right? Depending on their education and yeah. So do you know of that? Is it a good question, or?
That is a good question. I'm honestly, I think just because of the default of my brain goes whenever there's kind of like control or flexibility issue, it just goes to trust. I haven't come across too many situations, but I guess, if you're to have a partnership agreement or a shareholder agreement, and you hold the interest in the shareholder as a corporation, maybe that could work, but it just doesn't give you the same flexibility that a trust does. A trust, everything can be discretionary. You can make decisions later on. With a shareholders agreement, the guidelines kind of have to be set when the agreement is made, as opposed to when the distribution is made. And to an extent, trusts do too. You need a trust deed and everything, but trust deeds often, one of the great things about them is things can be very discretionary. So it gives you added flexibility and control that maybe a shareholders agreement might not provide.
So I think, just shifting gears here, I've had a conversation with numerous clients, prospects, thinking that they should set up a trust because it's just something people do at their wealth level. Now, granted, many of them overstate what they think they should do based on their wealth level, right? Like, hey, I inherited $100,000, I should put it in a trust. And meanwhile, they've got like 90,000 of TFSA contribution room, right? So it's like, there's obvious examples there. But when should the, I'm going to say average person, but like, is a trust the right fit for as a financial planning tool, as a control tool, or just a flexibility, like something that provides more flexibility to the average Canadian who's going to work a 9-to-5 job, who's going to maybe inherit some money from their parents, who wants to buy a house, provide for their family, their kids? Does a trust ever come into play in those kind of looking at the median or normal kind of Canadian family situation?
I honestly, I try to steer away from them because I think it's just very complicated and very administrative. There's a huge administrative burden to kind of deal with them. So for most people, I don't like to deal with it. But now I do think, certain types of trust, like, if you have a child with a disability, a qualified disability trust, or a lot of people, if they're going to die, if both spouses are going to die, then in your will, you might want to put like some sort of testamentary trust for minor children. You don't want, minor children to inherit, hundreds of thousands of dollars and then spend it recklessly. So I do think it's a good thing for a lot of parents to kind of have in their trust, in their will, in case both parents were to sort of pass away. But generally speaking, the majority of people should not have trusts, right? Like it's not fun. Sometimes I feel like people love the idea of adding complexity when it isn't needed. And I think a lot of times it isn't needed for most people's situation. So I would try to avoid them. But when there's a clear risk or clear benefit where where it outweighs the costs and the issues, then I think it could make sense.
Is there a general, like, okay, so maybe someone is suitable for a trust. We kind of look at this on the investment side where it's like suitability versus actual best use case, right? So is there a push from accounting firms or legal firms to implement trusts because they're a little bit more complex? They hire or they can charge a little bit more administrative costs and fees. Does that exist within the professional services industry that like you guys are a part of, or is it mostly like client brings it up, you guys do a suitability assessment, if it's suitable, yes, let's do it, if it's like not actually in their best interest or it would cause more headaches, then how you guys say, you know what, like, don't bother?
You know what? I think this is kind of one of the reasons why I got my CFP, is because I was seeing things from one lens and I wasn't seeing the holistic picture. And I think, yes, you do have perfect, and I don't want to say you do have, I've seen situations where people have recommended trust structures where I actually didn't think it was a good idea, right? And why would that be? It's because, that lawyer, he deals with trusts a lot, and, he can understand, oh, this is the benefit of the trust, but he's not thinking about all the additional costs or if it makes sense in the grand scheme of things, right? And so I'd be like, oh, why would they do that? There's one trust called an alter ego trust. And there are like, it's good for two things. Number one, if you're worried about what your will says and if you're worried people are going to contest your will. And number two, it saves on probate fees. And sometimes when there's no real issue with anyone contesting your will, I still see it recommended, and it's, to save on probate fees. And probate fees are like, 1.5% in of the value of your assets in Ontario. It doesn't really make sense a lot of the times, right? You don't want to add all this complexity unnecessarily just to save on probate fees when the market goes up 1.5% a day or goes down 1.5% a day. So I do see that situation happening where people recommend trusts, especially professionals. But I also see the opposite, right? Where people will see something, read an article, or, watch a video, and they're like, oh, I need to do trusts. I need to do this for me and do that for me. And they really don't need that added complexity.
Yeah, this is the same pitch you hear from a segregated funds seller.
Literally going there myself. I was thinking, no, segregated funds. No need for trust. Let's do segregated funds.
I'm not going to say who, but I met someone when I'm in Whistler, and he was trying to tell me how segregated funds were the best thing since sliced bread. And I was like, please convince me, go ahead. And he was like, yeah, you say, you save on on fees, sorry, what's the name again when you
Probate
fee?
fees.
You
Yeah.
save on probate fees. And I was like, all right, okay, how much are probate fees? Let's say 1% and change, right? I think in BC, 1.4.
1.4, I think. Yeah.
Right. Okay. And then you're gonna tell me that you're gonna pay 3% MER for about 25 years, and then you're gonna have about shitty returns of about 4.5 when the market is giving us, 20 over the last 3 to 5 years, and that's gonna outweigh the cost. Like, I don't know. It just makes me laugh, right? And it's the same thing we just mentioned: is you're trying to basically try to solve our problems, but you're just massively increasing the cost in the back end, right? So.
Yeah. I also
Yeah.
see that actually the segregated funds, I see a lot of people pitch creditor protection, even if they don't need it. Like, oh, yeah, I want to protect my assets. Yeah, segregated funds. Why do you have
Like credit card
no
companies gonna
liability?
come calling.
I know. Oh
Yeah.
boy. Yeah.
Like I can see the case. There is a use case in some capacity, I think, for segregated funds within a corporation, especially corporations that are like high risk of. And again, this isn't legal advice, by the way. Like none of this is legal advice. We're financial planners and tax planners and accountants here, so like want to make sure that we caveat that. But like I've seen the use case for segregated funds within a corporation, but I also know that in some cases, like that veil has been able to be been pierced, right, with the creditor protection side. So it's not guaranteed 100%. But the other side of this too, another common thing I hear about trusts is that mom and dad want to set up a trust for their kids, so that if their kids get married and they get divorced, that their spouses can't walk away with their inheritance or half of their inheritance. Now, that has been a selling point of trusts for a long time with the high net worth community. But again, when it's talking about, from my understanding now, there's precedent for that if they can prove that it was set up in such a way to avoid that situation happening, or in other cases, that the trust doesn't actually provide that type of protection in that marital family situation where they're the beneficiary of a trust and they get divorced. The spouse has been able to access the assets within the trust. So have you heard about that? What are your thoughts about setting up trusts to kind of protect family wealth from divorce or anything like that?
Yeah, my wife's actually a divorce lawyer. So, there's an article. So the great thing is I can just ask her questions often, a lot of the times. And there was an article, I think last month in the Canadian Tax Journal, it's Canadian Tax Foundation. And it was about this exact thing, the value of, an interest in a trust. And I said this to her and she's like, to be honest, most divorce lawyers will not be able to kind of identify this. And then the second thing is oftentimes a lot of this can be protected through, a prenup agreement or a marriage agreement. And I said, that's great because a trust is going to add so much more complexity unnecessarily that I would want to avoid it in these situations. And she's like, yeah, if that's a risk, right? If number one, if the risk is that they can kind of access whatever's in the trust, and then number two, it can be the same protection can be provided in a prenup agreement, which you should have in general, then why would you use a trust and why not just get a prenup, right? And I think that's a great point, to be honest.
Yeah, except unless like the couple doesn't want to get a prenup, right? Because then it's like, because like what if the couple doesn't want to get a prenup, but mom and dad wants you to get a prenup because like you're gonna inherit a bunch of assets. Yeah, I this might come as a surprise, but like because I know most financial advisors and most people, lawyers and everyone, like get a prenup. I'm actually like not a fan of prenups. Like I don't advise clients to get them from like my own context. I'll talk to them about it, but number one, it's outside my scope, right? Like I'm not a lawyer. I don't provide this, but I'm not a fan of them. Yeah, maybe that's my own background on marriage and stuff, but like if you're getting married, you should share in these things together. And I don't like the idea of like planning for something not to work out when it's like something that big. And when I say that, I don't mean I'm like trying to be negligent and like, saying like the worst can't happen. But yeah, I don't know. It's not something I encourage clients to look into. personally, but I know other advisors do, and I'm not saying it's the wrong thing or the right thing, but I'm not a fan of prenups myself.
Yeah. But essentially the prenup is supposed to what? Supersede the marital law. So what you're saying, Sam, is just that if there's ever a divorce situation,
Mhm.
you would just follow the provincial like marital law in some ways, right? How you divide assets and all that stuff. You wouldn't want to carve out things in your marriage agreement or your prenup. That's what you're talking. That's what you're
Yeah,
kind of saying, right?
I'm just thinking about it from my own perspective, and I know this isn't always a good way to give advice, right? I'm just thinking about it from my own perspective, though. It's like my business is really successful. My wife's been a huge part of making that happen. You know, a prenuptial agreement, like even though she doesn't work directly in the business, a prenuptial agreement like that I would somehow or for some reason, even if like my parents gave me an inheritance or something like that, that my wife wouldn't be like, you know, that wouldn't be part hers. It's like that's like the point of marriage is like, you know, you're becoming one, you know, like basically one family unit that shouldn't be separated in my mind. So I just don't love the idea of pre-planning for that to be separated because I just don't think that's like if that's what you're planning for, then maybe I don't know, maybe marriage isn't the right path. But that's kind of my idea on it. I think it's different from like most people's view of marriage where it's like 50% end in divorce, so you should be prepared for it. My point is like just don't divorce. Like work on it. I know that's an idealistic stance, but like don't get married with the potential of getting divorced. And yeah, that's probably where I align more with Dave Ramsey than on any other thing. I'm not a huge fan of his, but he talks a lot about this too, where it's like, you know, that he's not a fan of prenuptial agreements. I'm kind of on his side on that too.
Funny enough, I was actually married before and I got divorced and now I'm remarried. And in both situations, like, and I knew the laws and she was a divorce lawyer. We both kind of knew the laws. And we both kind of chose not to have a prenuptial agreement. And it was for that same reason. Like, she's contributing way more. Like, sure, I might be, and she does well for herself too, but I might be making a bit more than her. And, you know, she's kind of take a back seat when she raises our child. Uh, and it's not necessarily fair to her that she's not going to benefit from that, right? We should share in the growth of the net worth. Now, I do still recommend it to clients because at the end of the day, you could decide how things should be divided in the case of a separation versus the government deciding. I think, you know, that probably makes sense. But personally, like, and having gone through a divorce and seeing, you know, and being very familiar with the rules, I still chose not to kind of get it. So I definitely can see where you're coming from there.
And that's hilarious that we're talking about this right now because literally over the weekend, I told Kayla, so we're getting married next summer, and I told Kayla, hey, we need to get a prenup. And she was like, why? And I'm like, wow, that's the thing to do. But like, she was like, but again, I'm not a lawyer. I've never looked into that, again, in terms of like wealth and stuff. We don't have a mortgage. We don't have kids. So we haven't even gone through a will yet. Right. So, but like, as soon as that happens, like we'll go through all those things. And I was like, well, that's what we should be doing. But I've never actually looked to hear Sam's, your point of view and then Mo that you've been through that and then your second marriage. So anyway, it's I can't wait to share with her kind of your views on stuff, which I totally agree. I mean, it makes a whole lot of sense. And Sam, Kayla's point of view was the exact same as yours. She was like, well, we're not gonna divorce. So and everything that we put into it is shared because like my success is also based on her and vice versa, right? Like I'm supporting her, she's supporting me. So
yeah. And I know we're getting a little bit off track here, but I want to caveat this by saying like I absolutely do advocate for shareholder agreements and buy-sell agreements in the case of corporations. Because I know some people would say like, well, because my personal view on prenuptial agreements is that it is in some cases, like in some way, like you're almost planning on what failure looks like. And I don't like that mindset going into a relationship conversation. Now, when it comes to businesses, it's different. But like just from like maybe more of a moral standpoint, I don't love the idea of that. But business is completely different because you do have to protect yourself in those situations. So I'm not trying to. I do want to draw like a distinction between those two things, right? Like when you're in a business with someone, you absolutely should have those protections in place in case the partnership or whatever you have in place does not work out. But I think with relationships, I just view it differently. And that's, yeah. So I just wanted to draw that distinction there. I'm not here advising clients not to have like shareholder agreements based on my view on this, but like, I think, yeah, I just view it differently with the marriage side of things.
But it's I mean, I think we're digressing on the topic, but it also depends on the personal side, like on the stage of life you're in, when you meet, like the levels of assets that you walk into the relationship with. Like it's totally different if we met at 23 years old and we all grew together versus when you meet someone at maybe 55 or 60 and then someone's walking in with like having sold their, certain property. Like, it's just there's totally different situations. So I'm not saying that, like I agree with what you just said, like for a lot of people having legal contracts in place makes a ton of sense. It just depends of your situation. Yeah. And then on the business side, 100% have it cleared out. Yeah. All right.
Yeah,
Any last words? We're
prenups are not bad. It's just personal preference. That's because to be fair though, and I know we're really getting off topic, but I've seen a lot of people also in really tough financial positions because of their divorce.
Mhm.
And so we have to talk about the other side. So I think if you're worried about that risk, it does make sense, but everyone their own, right? You don't need one, you might want to get one. So I think investing in your marriage probably makes more sense than investing in equities and things like that.
I like that.
put your same budget towards therapy session and marital coaching and that kind of stuff. It's gonna reward you a lot more benefits over the
Yeah,
long term.
we're team pro marriage here. Like, let's make it happen, and let's make it. Yeah, I like that. Yeah. No,
Awesome.
I love this episode though. Like talking about, because I think it's funny how we digressed into relationship stuff, because I do feel like that's such a key part of why you'd want a trust set up. And having these types of conversations, ensuring that, from a financial position, it makes sense if you want to maintain control over things, if you want, if you want to make sure that holistically you're taking care of things, but it's not the be all end all. It's not the solution that covers everything, right? And so just knowing the downsides or the potential implications of trust can be a light bulb moment. And as advisors, I think our job is to identify where it's appropriate and where some of the, I think even going a step further and identifying maybe where it's not appropriate, right? I think, the more we learn about trust, the more, we can spot those opportunities. But at the end of the day, one of the reasons why we work with Copilot is because of those kind of insights that Mo shared with us during this episode, is because they're not order takers. They don't say client wants trust memos written, lawyer sets it up. It's like, hey, let's go through this at a deeper level. Let's make sure that it's actually the right solution for you. And then you'll be well set up. And so I appreciate that about you guys. And I think it's a great topic to learn more about, and the ups and downs of trust.
I mean, one big question that we could investigate further would be bypassing this entire planning approach and then exploring, at what age can someone be able to handle, a certain amount of money, and then how much is too much money, and also what role can we have in educating them to be able to handle that type of wealth at in their 20s, and what kind of role can we spend on, and can we do, and how much change can we bring into that, instead of trying to focus on like maybe a more complex structure that will depend on the family, depend on the kid, depend on like a lot of factors. But I think it's fascinating because in some families maybe you absolutely need control, and in others it's like someone in their mid-20s could be extremely responsible. They might be running their own companies at that point in time, right? I don't know, I just find it fascinating there.
Yeah.
And then maybe we're gonna have a next episode on how to educate kids around money.
There you go.
That's a great topic.
Meanwhile, Isaac is 1 year old, and then Mo, I think you're expecting, and I don't have any kids. So maybe
already talking to him about taking over the business one day. So
Succession plan.
Do you have quarterly meetings and you walking him through his RESP, portfolio updates and whatnot, and kind of how the market's doing? There you go. That's
quite literally walking him through it. Yes.
Awesome.
Yeah.
Well, thank you everyone for listening. And as usual, everything's going to be in the show notes. If you want to reach out, have a conversation, you can do it via our websites. And with that being said, we'll see you in the next episode. Have a good day.